All right, ladies and gentlemen, we are back for another exciting Investors Performance Group meeting for you guys tonight. It is August, but we don't stop because the market doesn't stop. We have a full schedule for you guys tonight and some awesome guest speakers that I cannot wait to dive in for you guys. And to kick things off, let's bring up the slides. Let's go right into it. So let's swap it to here we go. All right, we are the Investors Performance Group. We are a monthly meetup that gets together to talk about investing in real estate across the greater Vancouver and Fraser Valley area. We've been doing this for over 14 years in the area. And of course, we love keeping you guys up to date with what the strategies are that are working in today's market so you can take advantage and grow your personal wealth and your portfolios. We like to kick things off with a little bit of an introduction as to who we are. Of course, if you're new here joining us, this is your first time watching one of our live streams. We are the Kelly Fry team. So we are a full service real estate investment focused team here in the Lower Mainland Fraser Valley. Not only are we here to help guide you with your buying and selling of your properties, we have all of the service providers you need to set yourself up right, whether it's the lawyers, the accountants, even home inspectors or contractors. For every strategy, we have your people ready to go so you can start taking advantage right away and start taking action. And of course, tonight's agenda, we are going to do our typical market deep dive. We're going to go deep into the numbers, what's happening in the Lower Mainland, so you know the areas that you should be targeting and taking advantage of out there. Of course, we have the authors of One More Home coming. We've got Rick Hoogendoorn and Ralph Case. I'm excited to hear from them. We actually had Ralph Case back in February join us and talk a little bit about his book, but now we have both offers, and this is going to be an exciting one for you guys because you're going to get both of their perspectives on why they believe everyone in Canada should at least own one more home. They're both avid investors as well. They've been investing for a long time, and we're going to be asking them some hard-hitting questions that hopefully will help you guys be able to take the right action out there. We've got a couple of hot deals for you guys tonight. We're out there looking, running cash flow numbers, seeing what's working out there as well. So we got a couple to show you tonight, and then we'll let you on your way. We'll be about an hour to an hour and a half in total here for you guys. And yeah, let's kind of go into it. Of course, we love to get engagement. So if you guys are watching and you're joining on the chat, make sure you guys chat on the side. First and foremost, let us know where you're tuning in from, where you're at. And of course, we love to see your screenshots. Take a photo of the screen, any of the big ahas that you guys are having. Post it, tag us on Instagram or TikTok so we see that you guys are loving the content and what you're specifically taking away. Plus, it also helps your friends and family and other people in your network see what you're doing, especially if you're going to start raising capital out there. All right, let's talk about it. The market. This is one of those things where everyone is loving to have that conversation. What's happening with the market? What's happening with the market? And honestly, there's a lot of things going wild. But of course, you've probably, if you've heard me before, you know that I talk about the fact that there's no such thing as a Canadian real estate market. We look at this from a standpoint of all the different markets across the Lower Mainland and how they're operating independently. Because one area might actually be doing fairly well, whereas another area not too far away could be absolutely in the dumps right now. And as an investor, you need to know those spots depending on your strategy. If you're looking for areas that are continuing to depreciate and you can write lowball offers and get them accepted, you need to know where those areas are. Or if your play is to find a more stable market where you just want something that's going to be steady 80, again, you need to know where that is. So let's dive into it. First and foremost, from the Greater Vancouver Real Estate Board's president, home sales registered in Metro Vancouver declined nearly 10% last month relative to July last year, erasing the 10% gain that was seen in June that kicked off the summer. We have definitely seen the sales really start to slump through the summertime, which is to be expected. We are into the summer months right now. It's not normally as active as, let's say, the springtime. However, we have definitely seen a drop off. Now, the good news is, while that's happening for a lot of the agents out there, that means that sellers are starting to notice their days on market start to go up. And we all know that days on market for a seller is the enemy of a home's value. And that's exactly what you as investors need to know. Fraser Valley Real Estate Board says home prices continue to edge downward in July despite improving affordability. Buyers remain cautious, keeping sales well below typical season levels. Now, how we do our market update is we like to look at things from a bit of a broader perspective, and then we're going to dive into all those local markets and break things into those micro markets from condos, townhouses to sub areas, really pick apart a few different areas to show you what's happening. So to start with the broad perspective, we've got our inventory levels. Now, as you can see here, while we are seeing low sales, the inventory has started to traditionally decline as we head into the summer months. However, what you see here is that it's not a huge decline. Like the numbers are not dropping steadily, meaning a lot of sellers are putting their home up on the market in the spring and they're leaving them up in the summertime. So again, we're not seeing that typical drop off that we experience in the traditional. Like you look here back last summer, it was a much steadier decline of people taking their homes off the market. So we've got around 16,143 listings on the market in Greater Vancouver, over 8,369 in Fraser Valley, and about 1,400. I mean, Chilliwack and District just stays pretty steady Eddie. The smaller market segment, but obviously there's some good opportunities we've been finding there. All right, now we look at sales. And again, this is where the relationship between sales and inventory is letting us know what type of market we're in and what kind of pressure we can see on home prices. So we've got over 16,000 listings in GVR, but only 2,051 sold last month. And you can see that is a steep decline from the previous month where we hit our peak. Obviously, things have started tailing out in Fraser Valley, and 180 homes only sold in the Chilliwack District. So when you start to see that you've got low sales and higher inventory continue to compound, you start to see that downward pressure on homes values. As you can see here, we have started to see a slight downward pressure in all of the categories here, continuing through the summer. We got a little bit of a boost. Some sales were happening in the spring. That's traditional. Gave us a little bit of confidence. And now suddenly we're seeing that pressure start to push. Again, good opportunity if you're looking to start taking advantage and writing those offers. Couple other things that we like to take a look at as well, obviously, is the sales to active ratio. Now, what we were starting to see through the spring months into the early summer, we were really peaking into that balanced market. Anything above 12% in an extended period of time is considered a balanced market, whereas anything below 12%, we're in a buyer's market. And as you can see, all markets have started to diverge into that close to the borderline buyer's market. We're at 12.2%, just slightly into that balanced market for Greater Vancouver, 12.3 for Fraser Valley, and 12.7 sorry, 12.7 for GVR, and it's 12.2 for Chilliwack. And one of the other metrics that we like to look at as well, just to see what kind of a deal you're getting in the market. Now, this is not an exact science because obviously this relates to the typing of property and where it is and everything else like that. But taking a look at where the average property is selling right now comparative to list, what kind of deals are people having? So as we can see here across the major markets, you've got around a 5 to almost 6% discount. Most people are negotiating off of the final list price. So if you're able to negotiate anything below that 6%, you're likely outperforming the market and getting some money on the buy, which in this market is just hedging the decline a little bit and hopefully keeping yourself a little more stable as you go through the properties. All right, let's take a look at it. We start out east. We're going to go a little bit more zoomed into the market. We take a look at different market segments. We break it up between detached townhouses and condos, let you know what's happening in those regions. Now for Chilliwack, so we start out east, move our way west. Chilliwack, we're actually seeing a little bit of a rebound in prices in the detached market. It's up 8.7% over last year's sales, sitting around just under 1,988,000. And again, I do remember when, Chilliwack, which was weird to say, was like averaging like 1.1 at one point. So it's definitely come down over the last couple of years. We are seeing a decline in the inventory as we head through the summer months compared to last year, 280 listings on the market. And obviously the days on market is declining. So we are starting to see maybe that this market's a little more stable than some of the other ones that we're going to take a look at in the detached. When we move over to the attached market, condos and townhouses, we see a different story. Average right now has dropped 8.7% in the townhouses, averaging around 550,000. Inventory is on the rise, up 32%. Days on market has dropped a little bit, but it's still taking a little over a month, almost a month and a half to sell a townhouse now. And on the condo side, took a bit of 7.4% hit. Inventory has jumped up nearly 30% in that category over last year. So I do believe that we'll probably see some steady, just movement along with the detach, especially if inventory continues to drop. But if we continue to see this push in the inventory on the townhouses and condos, we'll probably see a sharper decline in those areas. Yuri, welcome in. You're joining from the tugboat all the way from North Vancouver. That is awesome. I'm glad you're able to make it while you're still working on the tugboat tonight. All right, Abbotsford, again, very different tale here. Abbotsford is taking it a little bit more on the chin in the detached market, down 18% over last year, averaging just slightly over $1.15 million right now. However, inventory has declined in that market and days on market has dropped over last year. Things are starting to sell a little faster. Maybe we'll see that kind of tail off. Maybe they won't have as big of a drop. Although I will say the inventory that we are seeing has not been the greatest. And that's why we've seen probably a lot of these properties selling way below the list price because we are seeing that market specifically. Buyers have become very aggressive with their offers. It used to be like a low ball was like 50 grand under asking. It's very commonplace to see like 150 to $200,000 under the asking price as a start right now in some of these Fraser Valley markets. And of course, a big part of that, in my opinion, is that it overinflated during COVID because everyone was moving out that way. It artificially boosted up those values sky high. And now they're the ones that are coming and crashing down the hardest because there's no reason why they were gaining at 34 and 40% year over year at the time. Townhouses in this market have fared a little better, and that's just due to the fact that people moving into that area, they're still relatively affordable. $660,000 for an average right now, up a little bit on the inventory, but not by much. It's pretty standard over last year. Condos, they're down 19% over last year, but we have seen a significant decline in the total inventory over last year. So I anticipate this will maybe start to level out over the next couple of months. All right, the Mission market. Mission, again, we've talked about it on this channel in the past, is a very heavy detached market comparatively. As you can see, total townhouses were only 65 and total condos, only 66 on the market total. That is a significant boost in the inventory, up 50% in condos, and it's only 66 still. But again, that's a lot due to the development that's happening. A lot of these condos that are hitting the market right now are either assignment of contracts or they're new developments that are completing and then those listings are hitting the market because investors had bought them at the peak and now they're just trying to liquidate them, get it off of their books, take their losses and move on. The detached market though has been fairly steady out there, still just under $1 million on an average property. The properties we're going to show you tonight on our hot deals are well below this average, which helps with the cash flow calculation. Inventory has dropped since last year. So again, we're probably going to see Mission stay fairly steady out there continuing forward. The Langley market is definitely one of the more expensive markets in the Fraser Valley area. At one point, Langley was averaging just under $1.8 million, which at the time made no sense. So we continue to see that downward pressure on the detached market right now, down now under 1.5% over 10% over last year. Inventory continuing to decline, taking longer to sell houses, pretty standard as we've seen. Townhouses have actually kind of leveled out. They were on the decline because there was so much townhouse development happening, especially in areas like Willoughby and even in Langley City Center. However, it seems like we've started to level out in that category and the inventory is dropping. So people are settling in now. A lot of that development that did close over the last 2 years have now either resold into end user buyers or people have now decided that they're going to rent it, likely taking a negative cash flow, meaning that those properties are coming off the market. Condos, though, on the other hand, we are still seeing there's a significant amount of condos. While inventory is down 23.9% from last year, still 423 condos on the market. This is an area where I still think we're going to see some serious downward pressure on home values because there's so much development. If you look at down 208th corridor there, Willoughby, massive amount of still construction happening there. Tons of development in Langley City Center. And in fact, Langley is one of those markets I like to zoom in a little bit more. We sold a lot of pre-sales back in the day in Langley City. And taking a look at Langley City comparative to the average of Langley, zooming in a little further, you can see that the detached homes have fared a little better, down only about 5%. Bigger drop in the overall inventory out there. However, you can see the Langley condos there in Langley City are taking a much bigger hit than the average in the area. So where do I see opportunities? There are a lot of condo sellers right now that are really desperate to sell. You could probably throw some stink bids in and likely get some really good deals under contract if you're in that budget looking for condos. Inventory has dropped 14% in that area, but I still see probably some more downward pressure over there. Every time I get a call from a client who's looking to get a valuation on their condo, and then they wait 6 months and they ask for a revaluation, the drop has been significant over time in that market every single time. Okay, jumping across the river, we're looking at Maple Ridge. Maple Ridge has been holding relatively steady, I find, down 5.5% only. Although I will say we did a bunch of sales just in the last 2 months in Maple Ridge. And honestly, some of the deals we have gotten, a detached home with a suite, with a massive shop in the back. Now, this was the first time home buyer I was working with, able to get into that property for $1.1 million. That same home probably 1.5 to 1.55 back at the height of the market. So we have seen property values definitely come down there, but it seems to be leveling off. We're not seeing as great of deals as there used to be starting to pop up there. I'm actively taking a client out tomorrow looking through Maple Ridge, and I'm still shocked by some of the listing prices that we're seeing for some of these houses. Inventory has dropped, obviously, taking a little longer to sell houses out there, 37 days right now. Townhouses down 8.7%. Inventory has dropped, taking longer to sell as well. Condos are actually surprisingly up over last month, which kind of shocked me when I was looking at it. But we have seen some big development happening in Maple Ridge, but not near as much as some of the other markets like Langley, Surrey, or other areas like that. So it seems like because they're only putting in a couple buildings every year or so, compared to the like 10, 15 buildings a year, this has been holding a little bit stronger in that area. All right, moving over to North Surrey. Now, Surrey itself is a very large area, and our board actually breaks the numbers out into four different areas. So already we're zooming in on one area. Then I'm going to show you another micro market, kind of zooming in to see what's happening. North Surrey, there's been a ton of development. Wally, or Surrey City Central now, has been going like crazy with towers and everything like that. We know a developer who's actively been developing in that area. And obviously, this is an area that's getting hit really, really hard in the market. Detached homes are down 12.7%. Inventory has dropped just over 11% now, just under 12, but it's taking nearly a month and a half, just over a month and a half, nearly 2 months to sell now, up 75% days on market. Townhouses have fared a little better. They've been pretty stable. Inventory has dropped, days on market is dropping, but condos took a massive hit in that area, and they continue to take a massive hit, down 16.7% overall in the North Surrey area. Inventory has dropped, but there's 716 condos for sale just in North Surrey. We're not counting all of Surrey in that number, right? And when we zoom in on Wally as an example, because that is where a predominant amount of the development is happening. You can see here that it's pretty devastating on both the detached market and the condo. Why I think that the detached market is taking such a big hit is that everyone is overinflating their values, expecting developers to come in and buy them and then put in, uh, low rises or high rises, depending where it is. Now, suddenly, those sellers are now having to realize they can't get those crazy prices. Developers are not buying like they used to because they are in a position where they can't even sell their current pre-sales. Talking to a developer we know recently, he's sitting on around 2,500 units that he's not even going to develop right now because it doesn't make sense. So they're not even in a land acquisition unless they find a really good deal. They're not buying above market value anymore. Like all these sellers, I'll go in on a listing appointment and the seller will tell me, oh, well, developer's going to buy this. So I want a multiple of X. And I say it's not happening right now. Obviously, inventory is climbing in that area. It's still only 91 detached, but still up. And it's taken about 50 days right now to sell a detached home if it's not priced well. Now, again, that's an average. Townhouses fared a little better in that area. Obviously, they're a little more affordable than the average of North Surrey. They're up about 4.8%. There's not a ton in the market when you consider how there's 125 total, 47 of which is in the region here. But again, condos in the Wally area, averaging right now 423,000, down 16.5%. Inventory has dropped, but if you just take a look at that number, Wally is making up a majority of the inventory right now in North Surrey. Right now, North Surrey, you got Boulevard Heights, doesn't have a ton of development. You've got oh my god, Bridgeview, things like that. So they don't have a ton of condos. So there is a majority of the bulk in this one centralized area, which is Wally. All right, taking a look at Surrey proper now. This is your Fleetwoods, Bear Creek, everything like that. Again, not faring too well. Detached is down just under 20% right now. They're taking a huge hit in this market. So to me, that tells me there's possible opportunities to throw in those stink bid offers and see which ones stick. Down 17% though on the total inventory, taking longer to sell houses. The townhouses down just under 5%. So they're not as strong as North Surrey right now, probably due to the proximity of people who are moving out and buying townhouses, but still having to commute to Vancouver. That will change as the Surrey Langley SkyTrain gets to be completed. Every time I drive down Fraser Highway now, it's like it's amazing to watch that big machine like putting all the pieces down the train like Lego blocks. So it'll be definitely interesting to see over time by 2028 when this is operational, give or take, what kind of change we're going to see down that Fraser Highway side of things. But townhouses inventory is down 20%. Condos little faring better in this area than North Surrey, down only about 3.3%. Inventory declining, however, up 133% for days on market over last year, 77 days now to sell a condo on average. Zooming into the Fleetwood market to give you a little bit of a cross section there as well. Again, down 11% on the detached homes. Fleetwood's a little bit more expensive than the average in the area for detached. Still a very highly desirable area to sell in Fleetwood. However, we have had a listing where the sellers have not wanted to necessarily move much on price. And we've noticed that it is very, very slow in that area if you don't have a listing that price is right out of the gate. We did finally get an accepted offer on that one, but it took a long time and several price reductions that, slowly chipped away until it made sense. Inventory is down to about 161 units in that area, down 14%, but it is 2 months right now on average to sell a detached in Fleetwood. Condos, again, a little bit of a bigger hit, just in general in Surrey, especially in Fleetwood, down 9.3%. But inventory has dropped quite a bit. There's only 44 units on the market in that area, and townhouses have paid fairly steady, not as big of a decrease as the average of Surrey right now. All right, let's move to the Tri-Cities now for those of you guys who are north of the river. So we've got detached properties. Coquitlam's taken a little bit of a hit just due to affordability. Again, there was a lot of areas specifically around Burquitlam and and Coquitlam Center where people were inflating their prices because they thought developers were going to buy. The amount of expired listings that I got called onto, and I had the conversation, they were listing at like $2 million, but the house is only worth 1.2. It's crazy, right? So we are starting to see that those sellers are now having to bring their expectations down to reality, and it's obviously having an impact on what's actually selling in the area. Down on inventory, down on days on market. Townhouses a little steady, down 1%, and condos not too bad, 3.2%. Just due again to that affordability factor. If you're looking at this type of home, you're probably not a first-time home buyer buying in Coquitlam more than likely. Even in the townhouse, you're probably an upsizer. Not, not a lot of people necessarily have the income to buy $1 million. So we are seeing that there's been a lot of first-time home buyers, starting to take activity in that condo market. Poco, a little stable on the detached, around 1.3, a little more affordable than Coquitlam. Inventory is up though, and it's taking longer to sell. We are noticing that we sold quite a few condos in the last 2 months in the downtown Poco area. And yeah, the offers coming in on these condos are aggressive. So you have to be very aggressive with your initial pricing strategy if you're selling. If you're looking to buy, again, might be some opportunities in that market. We have seen even just our buyers that we're working with, we are getting things that we didn't think the seller would take, and yet they're taking them. So that just shows you what's happening in that market. Inventory continues to climb in the Poco market, specifically in downtown Poco, because there's so much development to happen there. And again, Poco Central broke it out. You can see that the detached properties have actually taken a bigger hit out there. But again, that's just due to that idea where so many people were selling to developers. There's so much development happening in downtown Poco. Those sellers are now not getting those prices, and it's just over under 1.1 million. Inventory is up. Days on market is a whopping 2,133% increase. Pretty insane, but it's taken 201 days to sell a downtown Poco house right now. Nuts. Obviously, we've seen though the condos or townhouses are faring a little bit better out there. Inventory is only 12. There's not a lot of townhouses in Central Poco. Everything's been really focused on the development of condos, and that's obviously why we've seen a bigger drop in the condo market out there. All right, we're almost done here. New Westminster, we are seeing a big drop on detached. Again, it's one of those areas that it's a smaller demographic, it's a smaller community out there, but yet it really gets impacted by its neighbors in and around it, like Burnaby. And obviously, it's not the most ideal, in my opinion. That's my opinion. Not the most ideal place to live if you want to commute, because every time I get into New Westminster, I get stuck in traffic out there. So I think that's I will see some people feel that as well. And we're seeing some drop in prices out there. Inventory continues to climb, more people trying to get out. Townhouses holding fairly okay, down 2%. Condos taking a bigger hit. Inventory has dropped across the board, standard summer drop, but it is taking longer to sell. So that means buyers are sitting on this fence right now in that market, not taking as much action. Burnaby North, obviously, tons of developments happening in Burnaby North around the Lougheed Town Center, Brentwood Town Center. Those areas are going like crazy, super fun to go to. The new malls are fantastic. And what we're looking at from an investment perspective is it's still super expensive to buy a detached home in Burnaby North, $1.86 million as an average. And that is down 14.3, which means that we're no longer paying $2 million as an average out there. Oops. Again, inventory has stayed pretty stable, so we're not seeing a huge drop off in the summer. A lot of people are still selling. I was actually doing a presentation for a bunch of brokers at Van City recently, and one of the Van City mortgage brokers has had her home in North Burnaby for sale for the last 6 months. She hasn't had any movement on it. She's dropped her price multiple times. And she asked me what my opinion was. I said, have your agent drop the price again. That's all I can really tell you at this point. Townhouses have held firm for the most part, down only 3.5%. Inventory is increasing in that area, and days on market is increasing significantly. We'll probably start to see a little bit of pressure in that area. Condos are down only 4.6% as an average, but we will zoom in on Brentwood because that's where a big concentration of development's happening, and it's painting a little bit of a different story. But inventory has dropped into the summertime. As you can see here, we have no stats for Brentwood in terms of that's last month's stats because nothing sold in the detached market in Brentwood in the last month. There's 18 condos that are for sale, which is down 10, or sorry, 8 condos, detached houses for sale, down 10%, but nothing actually selling last month. In terms of Brentwood, though, townhouses are up 15%, but again, low inventory in that area. It's been pretty stable and up 50%, but it's 6 days. So when a townhouse is coming for sale, they are moving pretty quick still. Uh, Condos, a little more expensive than the average, down 5.2%, drop in the inventory overall. But again, this is that relationship 555 total in North Burnaby, and 339 of that, well over half, is in Brentwood right now. 42 days to sell in that market. And then finally, Vancouver East. We've made it back to Vancouver. They're holding steady right now. Not a huge drop in the detached, averaging $1.9 million right now. Inventory has declined, still just over a month to sell. Townhouses, though, have taken a big hit. Again, from an affordability factor, townhouses were well into the 1.3, 1.4 million. That's not super affordable for the average buyer. So those have started to level out now. Inventory hasn't really changed. It's still pretty high and taking longer to sell, up to 20 days. And condos, excuse me, about 6.3% down to an average right now, 678,000. And inventory is declining, standard, but is taking longer. So not as much action happening there. So that is your market stats for the month of August. As you can see, it is very, very important that when you're making your buying decision based on your budget and what you're looking to do with your strategy, you choose the area that makes the most sense and have a conversation with your agent, or if you're local, give me a call and we can have that conversation to let you know what's happening in these micro markets. Do you know the type of offers you can write that will actually make sense to match the numbers you're looking to do? All right. Also, I just wanted to let you guys know if you're listening to this, obviously we had Debbie Balfour and a couple other speakers talk about how social media is becoming a great way that even investors can start to get themselves out there. If you want to start taking action in the market today, but you're maybe tapped on cash, you need to build credibility in the market. And to do that, video is a great way that you can share your story, get what you're doing out there, and start impacting others who watch it. Social media is a free resource for everyone out there to put themselves out there. And to do that, I've been able to negotiate with CapCut a 7-day free trial for you for CapCut Pro to get all of their AI powered video photo editor for everyone. Honestly, CapCut is what I use for all of my video editing, especially when I'm doing my short form videos or when I'm doing my cringy dance videos that, tend to go viral, which is wild. It's had 60,000 views on one. Wild. CapCut's what helps me do that. Their AI editing tools really cut down the time for editing. And if you're a novice, you've never created content before, but you want to start sharing your adventures of investing out there, CapCut's the number one way to do it. Make sure you scan the QR code, or you can send me a DM and I can get you a 7-day free trial on CapCut Pro and try everything out. You can always cancel it right afterwards. But honestly, this has been a godsend, saving time for me in my editing. All right, we're going to move on to our guest speakers tonight. I am really excited to have Rick Hoogendoorn joining us from the island tonight. Rick is a real estate investor, rental apartment developer. He's developed multiple apartments on the island, and an international speaker. And before entering real estate, Rick also worked as an insurance agent and investment and personal finance advisor, giving him a unique perspective on the relationships between traditional financial planning and real estate ownership. One More House being his third book, and with his co-author, who we've had here before, Ralph Case. Ralph is a seasoned real estate professional, investor, and educator. He is the former president of the Real Estate Action Group in Greater Vancouver and the president and managing broker of Duroc Case Investment Realty. Through his work, Ralph has helped Canadians better understand real estate investing and how long-term property ownership can contribute to financial security. So in the chat, give a warm welcome to Rick Hoogendoorn and Ralph Case. Let's bring them up on the stage here. Hello, gentlemen. How are you doing today?
Good, thanks. Hi, Cam.
Hello.
So I believe you guys are going to give us a little bit of a rundown on your new book, One More House. And then we've decided to open up a Q&A because we wanted to make this engaging for our audience today. So if you guys are watching this, start thinking about your questions and make sure you throw them in the chat. And of course, I've got some questions for you guys after. But in the meantime, I will turn it over to you guys to maybe talk a little bit about your book and the concepts so they can get an idea what it's all about.
Well, okay. I'll let Rick start off the talking because I gave a presentation about 6 months ago. But I think a good way to start it out would be both of our vision of what the vision is of One More House.
Here it is.
Not one more home, one more house.
Well, it could be one more home. So, Ralph, what was your vision for the book?
Well, it went back to the story of growing up. I was the youngest of 3 boys, and when I came along, it was a 2-bedroom house, and so my 2 brothers shared the 2nd bedroom. I got the closet, like Harry Potter. And my parents ended up moving into a bigger house, and what was life-changing for them is they kept the first house, and all they did was collect the rent, whine about it, complain about it, have to do the roof or paint it or anything like that. But 30 years later, it was a multi-million-dollar property, and my dad's company, when he retired, after he retired, went bankrupt. So if he didn't have that one property, he would have been toast, but he was financially secure because he had one more house. So I've always been a real estate addict. I saw that and I just learned from it, and it's been the influence of my career. How about you, Rick? Tell us about lawn mowing.
Oh, no. Do I have to tell the lawn mowing story? My dad came to me when I was in my early 20s and he said, Rick, if you cut the grass, look after the tenants, we'll go buy this house in South Vancouver and we'll split the profits. And I thought about cutting the grass and dealing with these people that I didn't know. And I went, I don't want to do that. So he went and did it on his own, made a small fortune. And it took me another 15 years to get into real estate because I'm an idiot. So yeah, that's my introduction to real estate. And then as it was, we went into the financial planning industry. And what I noticed over time, dealing with mutual funds and life insurance and all that sort of stuff, is despite the tools that were available to us as financial planners, mutual funds, and so on, with those tools, I was unable to take somebody from poor to middle class or middle class to wealthy. And so when we read the Rich Dad, Poor Dad book by Robert Kiyosaki in the late 90s, my spouse Sherry got the real estate bug, and we ended up starting to buy condos and houses and went bananas. And that's kind of how it worked for us. And we did multiple joint ventures with family, mostly family and friends, and developed a portfolio from that. And it was really the leverage available through real estate investing that made the difference. And that's why One More House was something that I wanted to write.
And I think another thing that influenced us was just our experience, now that we're very experienced investors, but the experience with inflation and the experience of the buying power of money. And Rick added a great chapter where he compared money to a battery. And why don't you go into that just a touch, Rick?
Yeah, it occurred to me part way through writing the book that the Canadian dollar was like a battery, but it was a battery that was continually losing power as time went on, just in the same way that your phone battery loses power. And I did the calculations, and it's something like 95% of the purchasing power of the Canadian dollar has been lost since 1915. So really, it's not so much that real estate goes up in value because of the underlying land or the house. I mean, if you think about a 1915 house, the land is still the same. So the net value of the land has not increased in any way. And if you think about the house is 110, 111 years older. So it's in much worse shape than it was when it was new. So it has nothing, the value of the property increase is really much less about the inherent value of what's there than the decreased value of what underlies it, which is the Canadian dollar. And the Canadian government, as it is with many countries, aims to have an inflation rate of 1% to 3% per year. And so when you look at the increased value of hard assets like real estate, it's driven by government policy in many instances, not just supply and demand.
One of the interesting things is, looking at the history of people that I know that have bought real estate, anywhere from 20 years old to 45 years old to 65 years old. It doesn't make any difference, because if you buy a house with a 25-year amortization, even if it doesn't go up a nickel, it's paid off by your tenant. So, obviously a person starting at 20 years old is great, because by the time they're 45, they have a house free and clear. If they're 40, well, then they're 65. They start at 65, well, then they're 80. But it's never too late to buy a piece of real estate.
Yeah, we came up with this idea of a real estate RSP. So the subtitle of the book, One More House, is how just one rental property, a real estate RSP, could transform your financial future. And the basic idea is that rather than investing in an RRSP, which is a registered retirement savings plan, which is basically an umbrella under which you invest certain things, you use a rental property as the investment vehicle. And when you run the numbers, it's really quite interesting to compare a regular RSP with a real estate RSP because of how they grow. And as Ralph said, even if a property doesn't go up in value at all, it can still beat your regular RSP. And I'll give you an example. Let's say you've got a $500,000 house that you buy as a rental property, and over the next 30 years, your tenants pay off the $400,000 mortgage for you, so you own that $500,000 house free and clear. By contrast, you put in $100,000 into your registered retirement savings plan, just for easy figure's sake, and using the rule of 72, which says that your money doubles every 7.2 years at 10%. At 7.2%, it'll double every 10 years. So your 100,000 grows to 200,000, grows to 400,000, grows to 800,000. Now, we're going to give the RSP investor another benefit because they get a tax deduction for putting money in. So let's say they're so disciplined, they take the $30,000 tax deduction they get for putting in $100,000 into the RSP, and they reinvest that as well. So 130 grows to 260, grows to 520, grows to $1,040,000. So after 30 years, you've got $1,040,000 in your RSP versus a $500,000 rental house. And then you die. 50% basically of your RSP goes to the government. Where does that leave you? At $520,000 in your RSP, and it grew at 7.2% every year for 30 years. Your rental house, which didn't grow at all, is worth $500,000 and has no tax because it didn't grow, so it didn't attract any tax on the growth. So you may have paid tax on rental income as you went, but ideally, that in real world terms, because of expenses and stuff, that doesn't tend to be a massive amount of money. So that's the worst case scenario. Is you get zero growth over 30 years. What are the chances of that, given government policy at 3% inflation and that sort of thing? Certainly people, as Cameron just pointed out, are losing money in the short term right now. If they bought a house 2, 3, 4 years ago, they're not feeling too good. But over 5, 10, 15, 30 years, real estate tends to appreciate.
Another concept that we went over is if you live in a place like Vancouver, you don't necessarily have to buy the house in Vancouver. You could buy a rental house that cash flows better in Victoria or some other town that you see has growth potential, and it's a lot easier to carry, and it still will appreciate, and the tenant will still pay it off. You just have to get used to the idea of property management and paying someone to look after your house and identifying a good property management person and trusting them and letting them do it. So as an example, I've got some houses in Ontario that I bought with a partner. She lives there. She's my boots on the ground, and we have a property manager. I haven't been there in 3 years. I don't have to because I've got it taken care of. And they're just humming along, ka-ching, 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 ka-ching. And that qualifies for one more house. I bought them in the average price of $100,000 per house. They're probably worth in the neighborhood of $300,000 per house right now in 10 years. I started buying them in 2016.
So you're happy.
I'm happy. I you know, it's kind of funny because Rick and I have been working on this book for a long time. And the idea of one more house, it doesn't really mean just one more house. It's just, you know, where you are now, whether you own 10 or you own 3, why not one more house? I've always got my antennas up. And particularly in this market right now, listening to Cameron talk about the statistics, like holy smokes, you know, Mission average price $1,250,000 was down 5%. That means it's down 62,500. So if you're a buyer, that's fantastic. And if you have a condo, you know, even if it's down the same percentage, it's only like down maybe 20,000, whereas the detached house is 69,000. So it's a great time to move. God forbid you live in Fleetwood. I mean, Fleetwood was down 19.6%. You're down 264,000 in 1 month. But if you're a buyer, hallelujah, you know, because you sell your condo, for example, that was down 16.7%, that's only 69,000. So you're buying a house from a guy that's down 264,000, you're only down 69. So when your realtor comes and tells you got to sell at a loss, just sell so you have cash so you can go take advantage of these better deals in more expensive areas or detached houses.
There's a weird thing that happens with price. And I don't know why it is different for real estate than it is for cans of corn or gasoline or whatever. But when the price goes down for cans of corn and gasoline, we buy. It's on sale. When the price goes down in real estate, we get cold feet.
We panic.
It's weird. Hey, it's on sale, man.
And it's incredibly on sale. You know, Cameron talked about East Vancouver. If you're on the west side of Vancouver, there are properties that are down $2 million. I'm looking at one that in 2017 was tax assessment was 4.5, and I'm looking at it under 3. So, you know, it could go up in the next 10 years, probably it'll get back up to that level it was before. If it goes up $2 million, that's $200,000 a year tax-free if it's my personal residence. So the secret is for your personal residence, that tax-free appreciation is the best deal we get in our lifetime. So you want to have your personal residence probably the bigger the house, the better, because the bigger it is, the more it will appreciate on a percentage basis.
One of the other things that comes up when we talk about real estate is, you know, do you go for cash flow? Do you go for capital appreciation? Do you go for mortgage pay down? You know, do you do forced appreciation? Those are really the 4 things that we're talking about. And many people will emphasize this whole idea of cash flow. And neither Ralph nor I have emphasized cash flow. What we have emphasized is long-term holds, allowing time to do what we need the property to do because we don't like to work. We like to enjoy ourselves. Ralph likes to travel. I like to play soccer. We don't like to worry about things. We don't want to worry about the market going up or down, and what's going on with that. We want to take that information and make it irrelevant. When you're focused on cash flow, the amounts of money that we're talking about usually tend to be in the hundreds of dollars. When we talk about capital appreciation, we're usually talking about amounts in the hundreds of thousands of dollars. And so when you play a long-term game, focus on the zeros.
Cameron, do you have any questions for us?
Absolutely, guys. So I've got a number of questions. And again, if you guys are interested, we've got several people that are watching this. Feel free to throw your questions. We've got two very seasoned investors and developers as well in this this chat tonight. So make sure you guys ask your questions. First and foremost, I know you kind of touched on it, but you know, talking about that RRSP again, I want to go back to that. Why is it like, and I've got reasons why I would answer, but like from a perspective of like if you were putting money in an RRSP, and just from the leverage standpoint, let's kind of go on that aspect as well, because when you're putting money in a real estate property, you're not putting it all into one asset, right? You're leveraging the bank. Let's talk about how the difference in you going and investing your RRSPs into something versus real estate, adding the leverage component play into factor with the returns.
Well, you typically don't buy a $500,000 house with $500,000. You typically buy a $500,000 house with $100,000, 20% down, let's say, okay? And then the remaining amount tends to be paid off by somebody you don't know today. Now, do you have the ability to go and put $100,000 into a $500,000 RRSP and have somebody pay off the RSP loan for you that you don't know today? No. I mean, I've got a page open to the book here, and it says, if interest rates on your $400,000 mortgage average 5.5% over 30 years, the total interest paid will be slightly more than the entire mortgage of $412,000 in the advantage example I'm using here. If you average 6.5% on your mortgage over 30 years, the total interest paid will be slightly more than the price of the house of $502,000. If this financial cost is basically paid via rental income, that's a $900,000 cost for a $500,000 item that you contributed $100,000 to buy. And if you borrowed the original $100,000 from the bank of mom and dad, your rate of return is wow.
Yeah. Infinite at that point. Now, the concept of one more house. Now, I know, Ralph, you had said, you know, it could just be literally one more house, or it could be one more now, one more now, one more now. Talk to me about, like, you know, building a portfolio with stability, because I think that's the biggest issue that we absolutely saw in 2020, 2021 with a lot of investors that did get burned in the decline in the market. Now they're struggling. How do you take the concept of one more house and do it in a strategic way that doesn't, you know, grow too fast and suddenly when the market shifts, you're over leveraged at that point?
Well, leverage is a double-edged sword. So it's great when prices are going up, but it can be catastrophic when it goes down. Like, you know, I mentioned the detached houses in Fleetwood, you know, they're roughly 1.25 million. It goes down 260,000 in a month. Like, that's pretty jaw-dropping. So the best way to protect yourself from that is not to have excessive debt. You want to have debt that you're comfortable with. You know, that we had that stress test back during COVID times. Everybody was all upset, but that has saved a lot of bacon for a lot of people, because what happened. Interest rates went up and some people were caught with their pants down and others, you know, weren't. And I think that's what you have to do is when you're young, you can recover. So if you're in your 20s, you know, between 20 and 35, go for it. You know, leverage yourself. I leverage myself totally at that stage. Between 35 and 50, you got to start slowing down a little bit. You know, don't get quite so risky, because you're losing time to make it back when you lose. And then above 50, start being, you know, really safe, because, you know, this is the time you should start thinking about retiring. So don't take excessive debt. Protect yourself. Look at joint ventures. I love doing joint ventures because 50% of something is better than 100% of nothing. So I have little bird dogs, I call them. They're out finding me deals, and you'd be amazed at the deals that come across my desk. I mean, anything from a waterfront property in Pender Island to, apartment buildings in Sarnia, Ontario, Edmonton, Phoenix, downtown Vancouver, west side Vancouver. Like, there are deals everywhere. And this type of a market gets me so excited. When the number one biggest win I've made on an investment is the house I bought on the west side of Vancouver in 1994. I still own it. But at the time, an east side house was only like $100,000 different than a west side house. So one of my realtor friends said, "Hey, Ralph, look at this. Like, it's incredible." And I looked at it, I went, "It is incredible." So we ended up moving to the west side. So you got to keep thinking about, in this terrible downward market, you want to just, like Rick said, you don't want to buy because everything's on sale. Like, you got to start looking at, like, holy smokes, my property went down, but nothing like, where I really want to live, or nothing like this property that gives me incredible cash flow or is an incredible location. Keep your antennas always tuned. In this market, I guarantee you're going to make more money than you would in a booming market, unless you're a flipper. And I'm not a flipper. And I don't think, I know Rick is not a flipper either. We're long-term investors, and it works as long as you don't get too leveraged.
So if I may,
Yep.
I had coffee with a joint venture partner of mine about a month ago, and he is not well off at all. And the biggest investment that he has is the condo that we own together. And we went into a joint venture partnership years ago, and there's still a bit of a mortgage on it. And there was also a line of credit on it. And we needed the line of credit to pay a $22,000 special assessment on this condo at one point. And at the time, it was the largest special assessment we'd had to pay. I've since had to pay a $30,000 one, but let that be what it is. We've now had the tenants pay off the line of credit, and he's able to access a certain number of thousands of dollars in order to take his family to Costa Rica, because we co-own a condo together. And we are very, very conservative. Like, don't over leverage yourself. Always have options, because here's the thing. Things always go wrong. It's not do they go wrong, they always go wrong. And so what you have to do is you have to have sufficient resources or people that you can go to or whatever that can help you live through the tough time in order to get back to the time when it's going to be okay again. Think about 2008. It was brutal. We had to sell a bunch of properties during that time from 2008 to 2010. Right now, from 2020 to now, it's not been great, and it may be a couple of years yet before we come back to nice again, but things are on sale. And if I may, one of the things that happened was I took this book, down to Mexico with me over Christmas. It had just been done, and I gave it to my spouse, Sherry, to read. And after she read it, I said, "What do you think?" And she said, "No, it's a good book, Rick." And I went, "What? That's all? It's just a good book?" He says, "Well, she says, if I told you what I really think, you'd have a conniption." And I go, "Well, what do you really think?" And she said, "Well, I'm already thinking about all the people we can do joint ventures with." So it's not what this book is, it's what it does. What this book does is it activates people, in my humble opinion. And since that conversation, Sherry and I have bought a couple of properties.
There you go.
And I think it changes the perspective, like how powerful just one more house is. So what if you get 5? Like, holy smokes. It's...
See, this is where Ralph and I disagree. It's like, just start with 1, Ralph. Calm down. Calm down. You're at 5. He's going to go to 10 or 12 or 50. If you're at 2, think 3. If you're at 0, think 1.
Can I tell a funny story?
Yeah, Ralph.
Okay, I think it's Enbridge was, they have the gas to one of my properties in Sarnia, Ontario. So they're hassling me. My property manager wasn't paying the $70 bill, and they're calling my cell phone. So finally I call the guy. He goes, "This is Enbridge." And I say, "Yeah, you're calling me about, this bill, okay, give me your date of birth and what's your name? And, okay, what's the address of the house?" And I say, "Well, you're the one that called me." And he goes, "Well, I need the address of the house." I go, "Okay, so was it 118 Mitten Street?" He goes, "No." "Oh, okay. Was it 184 South Christina?" "No." "Was it 958 Claiborne?" "No." 626. And I'm just going through all these houses like that. Finally, I go, "Was it an apartment building?" He goes, "Oh, I can't say." "Well, was it 7 Vimy Crescent?" The guys, finally, we got the house that he's talking about. It was a rented hot water tank. But my family's listening to me like, "Geez, this Ralph, what are we going to do with him?"
I'm gonna say it's impressive. At least that you
It's a
still
nice
have all
problem
of
to have.
Yeah. There's a first world problem.
So here's a question that comes up often, and it's everyone's become very rate sensitive in the market these days. We saw rates drop like a stone during COVID, and then obviously we saw the meteoric rise up. In my opinion, the rates are, pretty decent right now where they're at. Like, they're not exorbitantly high, but they're not super low. But the conversation people keep having is, why should I wait until those rates continue to come down? I want to hear what your guys' opinion is on that, and how you would answer somebody who says, "I'm going to wait a little longer, see what interest rates do."
I recently renegotiated a 5-year mortgage, and I went variable because I think they are going to go down. Like, Trump has this new Fed chairman, and he believes in low interest rates. So low interest rates is going to spark inflation, and that helps hard assets like real estate. But I think that, they're probably going to go down in the near term. And if they don't, you can always lock in, or you just wait it out a little while and then eventually they go down. But the other thing with the variable rate is, if you intend to sell a property, the penalty is way less on a variable rate than if you get a fixed rate. And from what I've heard from mortgage brokers, a lot more people than you think sell before the term is up of their mortgage. So you got to think about that. Like, when do I want to move? If I want to move earlier than 5 years, don't get a 5-year fixed mortgage.
Essentially, if they're waiting then for that rate to go down, they're basically leaving money on the table in the future, right? Because you can't necessarily time that. If you wait to the rates to come down, someone else has already bought a better deal, possibly.
Well, more than likely, the real estate market's going to pop up when rates go down. So get ahead of the game, have a variable rate mortgage, and then take advantage when prices go up and interest rates go down.
I've got a different take.
Yeah, I'd love to hear it.
So,
as usual,
we don't know what's going to happen 3 seconds from now. In reality, we don't know what's going to happen 3 seconds from now, 1 day from now, a year from now, 10 years from now. We have no idea. So given that, what would you do? If you admit that you don't know what's going to happen,
lock in 5 years.
What would you do?
If it's a long-term investment, lock in for as long as you can. It's tax deductible for one thing. So whether you end up getting a 5% rate versus locking in at 6%, it's not that much difference because it's tax deductible. You can write it off against other income if it doesn't completely cover your house expenses, like taxes and insurance and mortgage interest.
I remember during the biggest boom market in Victoria history in 2015, 2016, 2017, I was in touch with a Vancouver investor who kept thinking the market was going to drop and then she could, buy in at a low price, and it kept climbing and climbing and climbing. And we had offers here of $300,000 and $400,000 over list price. And she never bought and missed the market. And right now we know for a fact that prices are on sale in all kinds of places, and it's better to get in and get the tenants paying down the mortgage.
Yeah, you can't time the market at the end of the day. We don't know when the bottom is going to be. We don't know when the top is going to be. Everyone who thought that we would keep going up suddenly are panic selling and getting out. Everyone's now waiting. They're going to wait too long. The market's going to turn, and they might have gotten a better deal that they just got in, wrote it down because they're not selling anyways, and ride it right back up, right?
It's the same as the stock market. The great thing about the real estate market is the price doesn't stare you in the face every day like, oh, it's down, it's up, it's down.
Yeah, we're just let it run, right?
Yeah, you just buy it and forget it.
We have Jeremy says, hello, Ralph. Hello, Rick. Looking good. And I'm just going to pop this on the screen here. I was wondering, if you are 65 years young and you have enough properties and wealth, why would you take a risk and invest in the real estate market at this age? Too much risk, correct? I'll let whoever wants to take that one on.
What's risk to a guy what is risk to somebody who knows the game? You're saying it's risky. I don't think it's risky. If you know how the game works and you remove the risk, it's not risk.
Yeah. And so when a really good deal comes up, I'm just thinking about a legacy, like, for my kids, teach them, show them how to do it. If it's a good deal, I might not go 100% into the deal. I might just go 50% in the deal because it reduces my risk. Don't get greedy. The old saying, pigs get fat and hogs get slaughtered.
Now, if you're talking about, Jeremy, if you're talking about somebody who's not a real estate investor and does not have a lot of experience in the game, and you're talking to them and saying, you've got enough money in wealth and so on, why would you take the risk in real estate? Then I get it. Yeah, you probably wouldn't because you don't know that game. But if you know it, it's like, I'm not in any way like Clint Eastwood makes movies, but why does Clint Eastwood make movies? Because he likes making movies. Why does Warren Buffett keep investing in the stock market? Because he likes investing in the stock market. You don't have to retire from a game you like and you know.
There are ways to mitigate risk too. Like you're paying rent anyway, so why not pay a mortgage? So buying your first house is a no-brainer. If you have a business, you're paying a lease for your premises more than likely. Why not buy the premises? So things like that dramatically reduce your risk.
So I want to talk about fear then, because a lot of people right now have a lot of fear, and you guys have been around and coached a lot of people as well. What are some of the fears that you have seen with first-time investors in different markets? Like, you've been through the 2008 market. You've already seen these down markets. What are some of these fears that a new investor has to think about and start to overcome if they want to take advantage of a market like this?
I think the number one is that the market's going to crash. People come up to me and they say they're convinced that the market's going to crash. And I'm just like, I've heard that so many times. Just look at the charts. Like, if you look at a Vancouver real estate board chart of sales from 1980 to today, it rarely crashes, and it rarely crashes for long. I bought at one of the worst times in history, 1994. The NDP came in and the market was literally flat to down for the next 5 years. So I had to just live through that, but I loved where I was living. I wasn't going to sell. I didn't really pay attention, just eyes on the prize, right? But I think the way you conquer fear is just look, what's the worst possible thing that could happen? And if you've bought a house with mortgage payments that you can afford, maybe hopefully a rental suite in the basement or something that is a mortgage helper, nothing's going to happen. The market's going to go down, it's going to go up, but eventually it's going to make you a very happy person over the long run. And I say the long run being maybe 10 years or more.
I think the biggest fear that most people have when it comes to, investing in rental property is the fear of tenants and having to deal with tenants. And, I don't believe in a confrontational kind of relationship. I don't think they're, like you treat tenants like they are clients, really. And, your job is to make sure the roof doesn't leak and that the washing machine works and that sort of thing. And I really lament the fact that a lot of landlords are absentee landlords. They don't take care of their properties. They don't treat their tenants well, and they give landlords a bad name. And I think you should treat your tenants well. You should do what you can to make sure that they have a safe, properly functioning home and be on top of those repairs and that sort of thing in a timely manner. I have tenants that phone me and say, hey, look, this is leaking. right? Like I want to know that immediately. Now, if you've got a bad relationship with a tenant, is he going to tell you that the thing is leaking? So, the thing to do is to treat people the way you want to be treated. And that's, it's a philosophical thing and a good business practice.
For sure. And that leads me to another question that I hear all the time. And I've got something I tell my clients all the time. But how important then for the average person is property management going to be in their business, especially if they're not good at the screening process, they're not good at handling tenants, handling conflict. How important does that become that you can still invest, but you just need to trade that off?
I'm 100% believer in property management. I don't know the names of any of my tenants, and I don't want to know their names.
Rick, thoughts?
We manage our own properties that are houses and condos, and we know the names of the tenants.
Because two different
and it's different, but hang on. When we owned apartment buildings, we didn't know the names of any of the tenants. We had property management because those buildings were 20, 30 units and more, and it was not practical for us to operate it. And at that point, I think your job is to manage the property manager. And I think one of the things that Ralph does very well is he manages his property manager. He has regular meetings with them. I'm sure he can speak to it more. But I think that's an important part of that aspect of things.
Yeah. And here's one of the things that I've noticed too over time. Like I've had situations where, I get a client who's looking to sell a property and the tenant has been in there and obviously not the best screening happened. That tenant shouldn't have necessarily rented from you. But unfortunately, some people are maybe too kind-hearted. They're too light. I'll say this as an example and rest in peace to my dear mother. But we had a couple bad tenants because they had a sob story and she felt bad for them, let them in, and they should never have passed the credit check or anything like that. So that's why I believe that you can absolutely, if you're like Rick and you're really a strong person and you can manage the properties well, awesome, all the power to you. But don't be afraid of investing. Just be aware of your strengths and your weaknesses, and then hire out to your weaknesses, right? Hire that property manager. Be like Ralph, be hands off if you need to be, or at least have that person there to help with the initial screening as well. I think there's a valuable asset in property managers who do the actual placements for you as well. You could still take over the management once you've got a good tenant in place too. So there's different ways to go about that, but don't let the fear of the tenants hold you back. Like Rick said, at the end of the day, and I have had some phenomenal tenants as well. Like, I had a tenant, I always tell the story. She had a cleaner before we had cleaners. Like she'd be like, I go in and be like, oh, I'm so sorry, the cleaner hasn't come today. I'm like, this place is spotless. How do you have a cleaner? You know what I mean? So absolutely, there's some phenomenal tenants up.
The other thing too of this is that this is a long-term game also as a real estate investor and a property manager. I made a gigantic bonehead error. Like a boom. Like, what are you doing, Rick? Last month, as a property manager, I wasn't paying attention. And so it's a learning experience. And if you keep learning and getting better, it gets easier, and there's no real way to avoid the lessons you're going to have to learn.
Yeah.
So a property manager, say you pay them 5 to 10%, it's tax deductible. Like, think of it that way. Like, they almost pay for themselves. And so when you hire them, try and get a referral from someone that you respect that would have contacts with a good property manager. When you have hired them, keep in touch with them. I have at least a bi-weekly call, if not a weekly call. I sometimes email them just to say, hi, how are things going? Send them gift cards, stay top of mind. I want my property manager, if they've got 100 properties they're managing, they want to think of my properties to rent. Be nice, smile at them, bring them flowers. It's tax deductible.
The flowers are tax deductible?
If you give them to your property manager, sure.
Who knew?
Who knew?
There you go. All right, we got a question here in the chat from Yuri out on the tugboat. Question: would you recommend recommend at 50 years old to go 100% into real estate or diversify and have some in precious metals?
I'm not a big fan of precious metals because what do? You stick them in your basement. You need a gun to protect them. They don't create any income. Like a house is a hard asset, the same as a piece of gold, except that it gives you a stream of income that is tied to the bag of groceries. So as inflation happens, rents happen. Like they keep going with the price of inflation. Gold, you go back to the 1980s, like it really, compared to inflation, it hasn't done a hell of a lot compared to the leverage power of real estate. You can't buy gold on leverage. You can't put 10% or 20% down. Like the best deal we have going is the CMHC 5% down mortgage. Like, Rick was talking numbers 20% down. If you go 5% down, it's astronomical what your return is. So again, the question is at a certain age, maybe what you want to do is just have a cash reserve. So put it in a tax-free savings account with something safe that's earning income tax-free, but that gives you a fallback position, because the biggest risk we have is a cash call, some unforeseen expense. So you need to have some cash in reserve. And that's where something like an RSP or a TFSA comes in handy, because you get the tax write-off going in, you get the tax shelter while it's in there. With the tax-free savings account, you don't get to write off what you put in, but everything you take out is tax-free. So each of them have their own particular advantages. But the older you get, the more cash you should have as just your safety net. You don't want to have to reinvent the wheel. I don't want to go back and build it all up again. Hell with that. I want to go to New Zealand or France or Singapore. I want to travel.
So this is from Yuri?
Yuri, yeah.
Yeah. So I think it would be maybe inappropriate for us, not knowing your full financial picture, to advise you of what to do, because we don't know when you want the money, when you're going to retire, what you're going to do with the money when you retire, and all that sort of stuff, what you're going to require of the money that you're going to invest, all that kind of stuff. So there's way more to this than you're 50 years old and do you do real estate or precious metals. Personally, I don't believe in commodity investing because it just goes up and down. And like I'm interested in long-term growth that I can rely on. At the moment, it looks like precious metals are a big deal based on what world events are going on and that sort of thing. Yes. And as Ralph said, there isn't the leverage in it that real estate offers, but we'd have to know more about your personal situation in order to really advise you, I would think, and that's not our business.
Now, Ralph, correct me if I'm wrong, you have a background in geology?
Yeah, geophysics.
Geophysics, and metals come out of the ground, right?
Yes.
Still won't buy them.
And you do electromagnetic surveys. You fly planes over the ground, and hopefully you find some big nickel deposit in Newfoundland that's worth $100 billion. There
you go.
But it doesn't happen very often.
They're very different types of investments. One's a short-term play. The other one's a long-term play. Yeah. Balance would probably make sense, but
yeah, if I was investing in the stock market, I would buy a dividend-paying stock or something that had a lot of momentum going up, but that had earnings growth, not just gold for the sake of gold's sake.
Mm-hmm. Now we've got some people that are likely watching this that are seasoned investors. We had Jeremy say, he's already been investing. Why would you take a risk? And yet we probably have some people watching this right now who haven't even bought their first investment property, and maybe they don't have the capital to get into that first property right away. Now, Ralph, specifically, you've talked about joint ventures. Let's talk maybe a couple strategies that investors who don't have capital but are very serious about getting in could maybe start to look at, so they could start taking action in the market without necessarily having the capital ready.
Before we start, I want to say something.
I'll let you guys.
The biggest problem with joint ventures, hands down, that we've seen over the last decades are people that go into joint ventures with people they don't know. Don't do it. Don't do it.
I agree.
It goes sideways. You must know the stress behavior of the people you're jumping into bed with. if you wouldn't marry them in that shorter period of time, why would you put your money together with them in a short period of time? So please only consider people who you know over the long term, like we did joint ventures with my spouse's siblings. We did them with long-term friends, with parents, with children, so we knew who these people were. And we've done dozens of joint venture partnerships over the years. But the two that we did with people we didn't know, Ralph?
I would definitely concur with that. Don't be very careful of going into a joint venture unless it's somebody that's family or somebody that you know very, very well. But I was also going to talk about, in the book, I talk about the first house I ever bought. I moved to Calgary as a young geophysicist, great job, but I had a big black dog and ended up dedicating my half of the book to my dog because I bought my first house because no one would rent to me. It was a booming real estate market. Kid shows up with a big black shepherd Labrador retriever. No dice. There he is. That's Satchmo. So I found out that in Alberta, you could buy a house without qualification. Like, you can just assume a mortgage. And so I just got on the phone to my parents and said, hey, I'm out here. Nobody will rent to me. Can you loan me some money? And I bought a house. The rest is history.
There you go.
Thanks to a dog. So call your parents, give them a shakedown, see if they'll give you some cash.
I had an uncle that was a developer, and he had one property left. I didn't even know when I went into town to visit him that he was a developer of this town and had one property left. And we saw this property and went, oh, this is all right. And he offered us a deal. We didn't have any money at the time that happened to be available for a down payment. So while we're going out of town and sitting in the airport, I phone up a buddy of mine and I go, hey, can I borrow $35,000? And he goes, okay. And I went, what? So I borrowed $35,000, bought that property. We still own it today, and it's now mortgage free, paid off by the tenant. And the tenant is an older lady, and she pays very under market rent because we don't want to raise the rent on this person. She's elderly, she's on a fixed income, right? She's paid off our mortgage for her. Why do I need to raise the rent?
Yep. Let's talk about structure of a joint venture, especially if you're that person who doesn't have the capital and you want to get into real estate, and you follow that rule of making sure you know who it is, all of that thing. You're reaching out to a family member, you're reaching out to someone who's got the capital, ability to help you qualify, whatever. What are some of the structures that you've seen that have been very successful when structuring a joint venture? So someone hearing this concept for the very first time kind of has the idea that they can start like looking into this and start putting these deals together that makes sense with the right people.
Well, you put together a joint venture agreement, and one of the lawyers that Cameron, Richard Letting, he's got a nice boilerplate joint venture agreement that covers all the bases. And you just put it in writing what the agreement is, like who's going to manage it, who's going to cover the cash flow if the cash flow goes negative. All kinds of things come up in a joint venture. So you just have to tick off the list and make sure that you're in agreement. Who's going to put in the money? Who found the deal? What do they get compensated for finding the deal? Who's going to do the property management? You're just going to hire someone. All of this stuff needs clarity. And that avoids disappointment the more you have that's clear and consistent.
Yeah, absolutely. And going into that conversation, likely having that outline kind of ready to go for that conversation, because if you're the one who's doing the joint venture, you're finding the property, you're trying to find the capital, you likely know a little bit more than sometimes the person you're pitching to, right? So having all of that lined out so that way they're ready to go and understood what their responsibilities are when you go to them, right? Rick, you look like you had something you were going to add there.
Yeah, so let me give you an idea that might work better in terms of a long-term play rather than the way it's normally done. The way it's normally done is you find the deal and then you run around looking for the money.
Yeah.
What if you look for the partners first?
Agreed.
And you went around and you said, I'm interested in doing some real estate investing. And I'm wondering if you might be interested in partnering with me at some point. You and I get along. Would you be interested in finding out the details of a deal if I happen to come across one? And the person's either going to say yes or no. And then you go to the next person and the next and the next. And you get a bank of, say, 10, 15, 20 people that have said, yeah, I'd be interested. Then when the deal comes along, you've got a bank of 10, 15, 20 people that you can go to and say, I found this deal. Are you interested? Timing will probably knock 90% of those people out of the running just because the timing is bad. And then the other 10% are in the running as a potential partner.
There are way more people with money than there are people with deals. So if you have an honest to God good deal, the money will find you 100%. And I totally agree with Rick's idea that you find the potential investors before you find the deal. Like, find your money people, and then you have to have the clarity and confidence to know what a good deal is and to manage it and not disappoint them. And chances are they'll buy with you again when you find another deal.
At that point in time, the joint venture partner potential, they actually become the asset, in my opinion, more than the property itself at the beginning. The relationship that's been created, that's what's actually going to get you the asset at the end of the day. And, you know, just as an example, like my first joint venture, I was taking all the rich dad education courses, right? Signed up for all those. And that's how I met Kelly. Actually, she was a mentor with that program. And I was just talking at my, so I was a lifeguard, and I was talking in the thing about all these things I'm learning nonstop. My first joint venture partner was my supervisor at the pool I worked with, because she just kept hearing me talk about real estate, talk about, well, hey, Cameron, we've got this home equity line of credit. We don't know what to do with it. And I could talk to my husband, and he's interested in talking to you. And so I found them first, and then we found the deal in that case. And so absolutely 100% agree with you guys. All right, I got one last final question for you guys, just to wrap things up. What is the very first action you guys would recommend a viewer tonight, or anyone watching the replay of this later on, after you're finished listening to the two of you guys, should take in terms of action after tonight's conversation?
Buy this book.
Ralph, tell me, you guys have a special with that book tonight, right?
Honest to God, I've had experienced investors say all this stuff is just gold, and they're giving it to their children and their friends and whatnot. But yeah, the deal is the rack price for it is $70, and we're offering it for $50 tonight. And the caveat is that we're going to have it available to be picked up at Kelly's office, because the shipping for this book is like, I forget, Rick, how much, $15 or something?
Yeah, I mean, it depends on where you are in Canada.
$20. Yeah. So if
it's only available in Canada, by the way. Yeah.
But if you pick it up at the office, it's free. And yeah, we're the reason Rick and I wrote this book is not to become gajillionaires. It's to make a difference in people's lives, like pay it forward. And it's just so exciting to see somebody take the information and benefit from it. It's life-changing. One more house.
Absolutely. Absolutely. And how can they order the book? What's the best way to reach you to get an order, so that way we can get it to the office and then arrange that?
The Kelly Fry team.
So
or afterwards, it's onemorehouse.ca.
So one more house.
If they,
yeah, we have a website, but if you just call the Kelly Fry team or Cameron, we'll figure it out.
Can you guys hear me?
I can.
Yeah. Okay. Something's happening. I lost my.
I can still see you.
I can hear you.
You can hear me, but I can't hear you guys. So, all right. So onemorehouse.ca for those of you guys who can hear. And or you can send Ralph or I an email. Ralph, if you want to let everyone know what your email is, because you're obviously on the Lower Mainland, or you can send me an email, Cameron at Kelly Fry Team. We'll get you that order. $50 for the book, no shipping charges if you pick it up from our office. Go ahead, Ralph. Let them know your email. I'll be able to see you talking, but I can't hear anything.
case.ralph@gmail.com. case.ralph@gmail.com.
Excellent. Okay, gentlemen, thank you so much for joining me tonight here. I think you guys brought a lot of value for our listeners. Guys, go ahead and get that book. You know, at the end of the day, even if it's not necessarily for you, but you can give that book to somebody else that will impact them. you're going to do your family a huge service. And I think what these guys have done putting this book together is going to impact many Canadians out there, and you can help by getting the message out there. Rick, Ralph, I do appreciate both of you guys tonight. I'm going to bring the slides back up and we're going to wrap things up and get everyone on their way.
Thank you. Thank you.
Thanks, guys. All right. So let's bring back up the slides here. And we're going to continue on here. We got a couple of hot deals for you guys tonight and some other fun announcements. So stick with me tonight and let's keep the ball rolling here. First and foremost, I got another offer for you guys tonight. If you do decide you want to start creating more content on social media and you start getting some activity going on, you've made some great reels with your CapCut app. I also recommend checking out ManyChat. ManyChat is an automation tool that's specifically used for things like Instagram, TikTok, WhatsApp that allows you to respond and do offers on those social platforms. So, for example, you might see those reels that say, comment this word and I'll send you this link. This actually will be great, Ralph and Rick, if you guys start doing some content about your book. And Ralph, we've talked about making you do that soon. This is a great tool that you can use to automate that so you don't have to respond to every single comment. I was able to talk to ManyChat and I was able to get everyone who signs up with the link and the QR code there 1 month of ManyChat Pro for free. So it's an even better deal than CapCut there. So check that one out. If you are looking to grow on social media and you are looking to start giving away offers, this is a great way you can do it. All right, let's move into our hot deals for the night. We've got 2 properties that we were able to find for you guys. One is a legal duplex in Chilliwack, and the other one is a suited house in Mission. Looking at those markets where not only can you find a really solid property that will gain you, the equity pay down over time, but also we are finding that cash flow is starting to definitely come back in our market. So you can get the best of both worlds if you buy right. Now, I've also ran these numbers because I don't suggest you guys go and pay the list price right now. I just showed you the stats at the beginning of this meeting tonight, and you can definitely put offers out there. So this is what we're looking at today. First and foremost, the legal duplex. We ran this based on current tenant rents, but I'm also going to show you guys the potential rent because I do find that the main house, because it's kind of weird. It's like a legal duplex, but it's a 5-bedroom suite on one side and a 2-bedroom on the other. The 5-bedroom suite is well under market for the area. So on a tenant turnover, there's huge upside potential in this. The legal duplex, the 2-bed is basically at market right now. 2,500 square feet between the two. 9,500 square foot lot, good size, built in 1953. Very unique property, but it's been updated quite a bit throughout. This is what it looks like. Its listing price right now is $900,000, but based on what we're seeing offers getting accepted in the area, I ran the numbers at around 840. This has been on the market now for about a month. And to me, that tells me that they're not getting a lot of activity, likely due to the fact that it is currently tenanted. We are seeing a lot of people shy away from fully occupied tenanted properties. That can sometimes create an opportunity for you if you're willing to take the risk of having someone else's tenants in this case. And sometimes you can mitigate that risk with a real good offer. So I figure if you can get this for around $850 a month, after you factor in your gross rent of $3,939 at current value, you're going to be making about $136 a month. Again, nothing to write home about. That's assuming a 20% down payment, property transfer tax, legal, everything else. You're looking at about $186,000 to get into this property, running it at about a 4.14% interest rate over 30 years. However, if you get a tenant turnover and you can increase that other 5-bedroom unit to market, what I was finding on the market right now is that a 5-bedroom in the area is going for around $3,500 to $3,600 a month. I'm using 32. I like to be conservative. I don't want to do exactly because who knows if they're actually going to get the 35. 32, I think, is pretty reasonable. That suddenly on a tenant turnover could jump your cash flow up to $736 a month. So a huge jump if you can get a tenant turnover. And in the bare minimum, at least hit them with the rent raises every single year and start catching that rent up. Based on buying it with the current tenants, though, you're looking at a total cash on cash of around 0.88%, return on equity of 6.25%, and appreciation 13.55. So a total of around just under 21% return on your money overall. Next one here is on Best Avenue in Mission. This is actually quite a nice house. It's had some updates throughout it. It's really turnkey at this point. It's owner occupied both up and down, so you can go right to get market rent there. Market rent in the area is sitting around $2,600 to $2,800 we found, and the 2-bedroom for around $1,500 in the Mission area. It's on a 5,000 square foot lot built in 1995, and honestly, Best Avenue, I've sold a lot of houses over the years to investors on Best. It is probably one of the nicer streets in Mission to find really good, solid tenants. I think we've done probably at least a dozen of the sales on Best over time. List price is 890,000. I think realistically, based on some comps I've seen recently sell, you could probably pick this up for around 850,000. Gross rent of around $4,100 a month, leaving you with a total cash flow after expenses of $308. Again, pretty strong cash flow considering that we just got off a market where nothing cash flowed, either due to prices being too high or interest rates being too high. Prices have come down, interest rates have come down, rents are coming down slightly, but not at the same extreme as the other two, balancing out and giving you some solid cash flow. Get around 188,000 to get into this deal, and you're generating an approximate return of 21.74%. So again, guys, cash flow is back out in the valley. We do find there's some good opportunities. You're still buying them for under $1 million. Those are two detached examples. Last month, we had some good townhouses we were showing. We saw a couple condos that started cash flowing again, which is super rare to find. That means with property values continuing to decline, we're going to see more and more of these opportunities start to come in. So take advantage of it. It's there right now for you. All right, to wrap things up, we got a couple of announcements. Hopefully you guys can hear my audio. I believe you guys can. First things first. Who's that realtor? We have a big announcement. We've got a new real estate agent joining our team tonight. Some of you guys might actually know him. So quickly, if you're still watching this, throw in the chat. Who do you think is joining the Kelly Fry team? I'll give you like a couple of seconds here, then I'm going to reveal it. And we did it like a little bit of a Pokemon theme because I thought that would have been funny. Like, who's that Pokemon, right? Anyone want to try a guess? He's coming back here. I think I see Ralph coming back here. Let's do the announcement then. Who is it? It's Ralph Peace! On board. I'm going to bring Ralph back up on stage here quickly. Ralph, we are going to be onboarding you onto the Kelly Fry team here in the next month or so, it seemed. We're just waiting on a couple of logistical aspects. Ralph, why are you joining our team?
I'm joining it because I've known you and Kelly for a long time. I appreciate your dedication to your clients, your dedication to systems, and the dedication to change as markets change. So you guys have had to really reinvent yourselves with the last few years of interest rates, taxation, all these effects on the investor market.
Airbnb
we
going
have
away.
to keep plugging along because this is the best time for investors to be investing. It's really kind of funny, as I look back, that when everything's on sale, people are running for the bushes and hiding. Like, you should aggressively be out there looking for deals, looking for joint venture partners, because there's still people with cash. Like, the stock market is at an all-time high. If not, it's close to the all-time high. It was last week. And so people have money. There's money coming out of their ears. You just have to identify these people and have the expertise to identify what a good deal is and how to manage it. And it's not that complicated. It's simple. Property management and a few numbers. Like, I love the way Cameron was just analyzing those potential deals. Like, it's just a numbers game. Plug it in. If you can't do the numbers, pick a realtor that can, like Cameron.
Or now we got Ralph helping us out. And honestly, we're super excited too, because Ralph brings with him years and years of experience in the investor community. And between our systems that we have in place and Ralph's expertise and his knowledge, we are excited to see what we can take with our investors in the market today and really just blow this up with everyone. So welcome, Ralph. We're excited. We can't wait to fully onboard you, but we thought we'd make the announcement tonight. Again, we're just waiting on a few logistical things. And we're going to make some big announcements here as soon as the paper, we put pen to paper, essentially. We draft that joint venture agreement.
And we're having our Tap and Barrel event on August 30th.
That's right. Actually, I don't think Jury put that in my slideshow. So that is right. I appreciate you mentioning that. So for everyone who's watching this right now, we are going to be hosting our annual end of summer party at Tap and Barrel in Brentwood. It's going to be on August 30th from 2 to 5 p.m. Tickets are going out really, really quick right now. We're excited with how the numbers are turning out, and we're going to have a blast. We do this every single year. This is our 4th annual end of summer party. And it's the first time that we've rented out the patio. It's like the upper, there's like 3-level Tap and Barrel at Brentwood. It's going to be a blast. If you guys would like to join, just shoot either Ralph or I an email, and we'll make sure to send you the link to RSVP. And yeah, come out, have a beer on us, have some food on us, and let's talk about your investment strategy and what we're going to do for the fall. So
I'll
Ralph,
bring some books and I'll sign some books.
there you go. There you go. Love it. All right. Let's keep ball rolling here for you guys. We got a bunch of other things that you guys can follow us on as well. Of course, follow the Kelly Fry team on our social media. We're across all platforms. We are omnipresent in that way. And a big shout out to our marketing manager, Jury, because honestly, from everything from marketing our listings for our sellers out there and making sure they stand out, to all the digital renderings that he does, to all the crazy reels that he makes us do to, just, show that it's a good time and not a long time, at the end of the day. Shout out to Jury. Make sure you guys follow us just so you can help him out so he keeps his job. Just kidding. And of course, if you guys would do me a favor, make sure you hit subscribe. If you're looking at this right now and you look below and that subscribe button is red, I want you to hit that subscribe button so you can come back and join us for all of our other IPG events, as well as we make a lot of great content on this channel. So come back, check that out. And of course, there's the Manning Up on Real Estate podcast as well, the separate YouTube channel. So you can check it out. We've got some really cool episodes that we had just dropped not too long ago, including one of my good friends, Paul Dominich, and his rise from going from windshield to Ironman. He was training for an Ironman and he ended up going through the back of a windshield, had over 80 stitches, was told he was not going to be able to participate. And in 28 days, because this guy's mindset is like a steel trap, he said, I'm not going to let people limit me. He focused on his recovery, focused on training, still ran his Ironman. And actually today, I just saw on Facebook, he just completed, I believe it's his 5th Ironman since this incident. And of course, we also had Scott Tolar. Scott is absolutely killing it in the real estate game on AI. He's someone that I watch quite often and learn from. So honestly, those two are great episodes. We got a bunch of other great episodes coming out. So check out the Manning Up on Real Estate podcast on YouTube. But if you prefer to listen to your podcast, you can also check it out on Spotify, YouTube Music, Apple Podcasts, all the major platforms out there as well. Also, join us on our Facebook group. So you can just look up Investors Performance Group on Facebook. Join the group. This is where we make announcements like our next upcoming IPG meetings. We also put it on Eventbrite as well. We sometimes post articles. I'll go live in there once in a while. So be a part of our community. Stay up to date with what's going on so you can, and honestly, I always say, if you've got a deal and you are looking for advice on it, post the deal in there. The community can go and help you out. We'll get Ralph in there and he can then jump in and say, hey, here's how I would look at this deal. So guys, go join our Facebook community, and our next month's meeting is going to be on September 17th. So mark your calendars, join the community, and we will see you then. Thank you so much for joining us, for everyone who joined live, and to everyone who's going to watch the replay again. I appreciate all of you guys, and we'll see you next month or at Tap and Barrel.